and I'm curious if you had to pick a top ETF story so far this year, what would that be?
I think we'd have to be crypto, Nate, which I'm sure will make you happy.
All right, joining me will be Daniel Noonan, Executive Vice President and Head of the Wealth Management Consulting Group at Cohen Steers, who back in February, they entered the ETF space with a launch of three actively managed ETFs. And of course, this continues an absolute parade of larger asset managers entering ETFs. Cohen Steers manages some $90 billion overall. So it's a huge shop, which again, we've seen a lot of these coming into ETFs over the past few years. But Cohen and Steers specializes in real assets and alternative income. And if you look at the three ETFs they've brought to market so far, you can certainly see that. These cover real estate, preferred securities, and natural resources. So we're going to take a look at those ETFs. And then we're also just going to have a broader conversation around active management and the rise of active ETFs and the current environment in the markets overall. So it should be, again, an excellent conversation. Now, to start this week, I am joined by Cinthia Murphy, investment strategist at VettaFi. And I thought since the third quarter is quickly winding down here, it might be a good time for us to take a little breather and look back on the year in ETF so far, and also look ahead to the remainder of the year as well. And so let me now welcome in Cinthia, who's joining us from Chicago. Cinthia, how are you doing? Great having you on the podcast.
Hey, Nate, I'm doing great. I'm excited to be here, and I'm excited to proudly wear my Mizzou t-shirt to remind you that KU lost after 12 years of waiting for the game.
I
So,
must say, after seeing that T-shirt, I wish that we were still just in the audio-only format and not video, so I didn't have to look at that. And for context, for people who are just listening, Cynthia is wearing a Mizzou Tigers shirt. I am a University of Kansas Jayhawk graduate, and they played each other in football a couple of weeks ago. Unfortunately, KU was on the losing end, and so it looks like Cynthia is doing a little victory lap here. Were you actually at the game?
yeah, we were. My youngest daughter is at Mizzou as a student, so we went to the game, and as you know, that game went to the very last minute. It was neck to neck, and nobody left the stadium until it was over, which is rare. It was super intense, total nail biter.
It
So
looked like just an amazing college football environment just on TV. So, of course, I didn't like the outcome, but I will say congratulations. And hopefully we'll get you next year. Okay, so I don't know where the time has gone, but somehow we are already barreling towards the end of the third quarter. And so, like I said, I thought this might be a good time just to take stock of everything in ETF land this year. And I guess why don't we start with flows? I don't want to spend too much time here. I'd rather talk about some of the bigger ETF stories, but obviously flows can be a part of that as well. And so I'll just give you an open mic here. What's most standing out to you on ETF flows this year?
So the record pace, which we've talked about. So far this year, we've had, and I pulled out some numbers for us today, $845 billion dollars in inflows already year to date. In the third quarter, as we're counting down the end, we're almost at 300 billion just this quarter. So the pace has been relentless, has been continuous. And what I think has been interesting is that some of that flow leadership has kind of stayed the same. So, for example, VOO, which was one of our biggest stories this year, which we'll talk about in a minute, has picked up another $60 billion so far this quarter, is at $121 billion year to date, which is unthinkable. It's crazy, crazy numbers. But also in that, top 10, top 15 tally, you have what I call the minis. So SPLG, large cap, QQQM. So that lower share price, lower fee versions of the big QQQ of SPY. These funds have been picking up a lot of assets. So you're going to continue to pick up a lot of assets while, some of the bigger counterparts are on the losing end. So Is this really the arrival of retail? Is this really just a reminder that, for all our tolerance for higher fees now, low cost is still the winner? So it's been an interesting time for the ETF market. And then I'll just add active, huge year for active, which we also know about 40% of flows have gone into active. Active ETFs hit over $1 trillion in assets. So some of these trends that have been started since the beginning of the year, they continue through the third quarter.
So I'll just offer a few quick comments here. In terms of the active ETFs, I'm going to talk about that with Daniel Noonan at Cohen Steers, so we can skip that one here. The record pace of ETF inflows overall, you mentioned that 845 billion, and I know I'm a little bit of a broken record here, but of course last year we set the record at, I think it was around 1.1 trillion overall. So we're right on pace to exceed that. And as you know, the fourth quarter of the year always tends to be the strongest for ETF inflows overall. So I think that's clearly a remarkable story, just in terms of ETFs overall. And then VU, it's like, what more can you say about VU at this point? Over 120 billion. Last year's record, I think we landed like at 116 billion for VU. That was an annual record for an ETF overall. And to see us sitting here in September with VU already exceeding that, it's just mind-boggling, the numbers that that ETF is putting up. And then the last comment I'll make on the mini ETFs. So I was looking at the flow leaderboard overall as well, and what's noteworthy here. So SPLG, the mini SPY, that's currently number 4 in inflows overall out of about 4,500 ETFs. You look at QQQM, which is the mini Qs, that's number 6 in flows overall. Again, out of all ETFs. And then even if you go a little bit further down the leaderboard, you'll find GLDM. So mini GLD, that's in the top 30 out of all ETFs. So I like that you picked up on that trend. And I do think that the obvious reason to point to here is clearly cost. What I'll be interested in, I don't know if you have any thoughts, SPLG, you look at the flow numbers that's putting up, I just wonder, that could be a threat longer term. I know SPY is the liquidity king in the S&P 500 ETFs, and I don't know that anybody is going to catch VU or IVV, but SPLG with those numbers, it's quickly rocketed up the leaderboard.
Yeah, I mean, I can't imagine a time when, the professional traders and folks who are using these ETFs for different hedging activity or things like that are going to pick SPLG over SPY. But we also didn't see VOO coming. So it's a never say never type of market, I think, in the ETF space. And what I'm really curious is this just mutual fund assets moving into ETFs? Is this generational money, younger money, retail money? Is this, the assumptions we make is lower cost, these smaller versions, ETFs, lower share price, is sticky assets, it's long-term assets, is not play money, it's not trading money. So, but I don't know. I'm really curious. It would be great to know exactly who's buying these ETFs, but there's definitely a shift and a strong establishment of the minis and the lower cost beta ETFs for sure.
Yeah, I think with SPLG, it's really all of the above. And remember, SPLG is only at 2 basis points on its fee. VU and IVV are at 3 basis points, which, by the way, one of my predictions coming into the year was that either VU or IVV or both would chop fees to match SPLG. They haven't done that yet, but I wonder if with the flows that we're seeing in SPLG, that will get their attention.
I don't think VOO is feeling pressure, but okay.
Yeah, that's fair. Not with 120 billion plus in inflows this year. Okay, let's move on from flows. And I'm curious, if you had to pick a top ETF story so far this year, what would that be?
Other than VOO, well, it's a really tough question because there's a lot of interesting stories. And I talk internally with our team, as you know, to kind of like, what are you guys feeling about the biggest stories? We do that a lot internally to get a sense of, from a research perspective, what's standing out. And I think we'd have to be crypto, Nate, which I'm sure will make you happy. But not just from a flows perspective, really getting that strong foothold in the market. The adoption and performance of Ethereum ETFs, which are this year's brand new group, incredible. But I think from a regulatory perspective, so much has happened on that front. The in-kind creation, redemption, approval, the exchanges trying to streamline listing processes. I mean, I keep going back to this survey we did recently, a couple months ago with advisors about crypto investing. And over 50% of advisors said now they're really interested or much more interested in crypto because of regulatory clarity, because of all this movement and regulation. So I think crypto has been a huge story this year. Again, it was a big story last year, but it's just, I think we have barely started to see the size of that market potential.
Did you see my eyes light up there when you said
I
crypto
know you're
ETFs?
sparkling right now.
Here's what I'll say about that is if you look at the flows into both spot Bitcoin and spot Ether ETFs this year, we're talking about over $32 billion last I checked between both of them. And I remember if we go back to early last year when the spot Bitcoin ETFs were just launching, there were a lot of industry pundits and experts that thought these categories would be like $5 billion total. And here, just this year, we have $32 billion in inflows. And if you look at the combined assets in both of those categories, $185 billion between those two. And to what you were saying on the VettaFi survey, I know, again, I'm a broken record here on this as well. I still think we're early because I think advisors are still getting comfortable with the idea of allocating here. I think you're right in that because we have more regulatory clarity, they're more comfortable with that. But a lot of advisors are just now starting to even think about making an allocation to these. And not only that, I'll add that here probably in the next month or so, I think we're going to get additional regulatory clarity, at least in the ETF space. We're going to have this generic listing standards, and that will help streamline issuers bringing crypto related ETFs to market. So I know some people get tired, particularly of me talking about this, but I don't know how you can't look at this and say, yeah, this is clearly one of the biggest stories in ETFs in 2025. Let me ask you this. If we were to put that aside, is there anything else that you would point to as a top story? Because some people, again, I know are fatigued on the crypto ETF stuff.
Yeah, I think if we put that aside, but just not really aside. I think the other thing that's been interesting is, every year we talk about the importance of diversification. And I think this year, the actual appetite for diversification has been impressive. So if you put, I was doing the math earlier this morning, if you put like everything that's not equity or fixed income, so alts, asset allocation, commodities, and crypto in one big bucket and look at flows in that space, that category has picked up about 12% of all flows this year. But if you look at all the total assets of these categories together, that's under 4% of total assets. So it's picking up 3 times its weight this year. And I think it's been for all of the strong performance in the tech and growth and some of the areas of the market that, the record highs in S&P 500 and NASDAQ. Investors have really embraced the call to diversification this year in a way we really haven't seen. And so I think that's been kind of like the more quiet, the numbers are there really supporting the story that there is nervousness in the market, even as we keep hitting record highs, and we continue to see that.
I think that's a great point. I think we'll continue to see that moving forward. But you know what that makes me think of? If you go back to the very beginning of this year, something that I think a lot of people thought was going to be an enormous story in ETFs in 2025 were private assets in ETFs, and partly because of what you're talking about in terms of this diversification component. That's what they're being pitched as, a little bit higher yield, perhaps a little bit less correlation to some other assets in a portfolio. And you look so far like the Spider SSGA IG public and private credit ETF PRIV, that has less than $90 million in inflows since launching in February, which isn't nothing. But I think given the hype in the space, there were much greater expectations for flows here. And they also just launched a short duration version of that ETF as well, PRSD. So, clearly State Street is still optimistic here, but demand has definitely been lackluster overall. Any thoughts there? Because I think you're right on that diversification story, but maybe why has that not translated into this private credit or private asset space?
To me, private assets was the story that wasn't, to your point, and but I think it's just early days, Nate. I think it's a space that has proven what we've always understood to be the case, which is really difficult to access. And with an ETF, which is daily trading and super liquid in and out, is really difficult to package that in an ETF. So I think we're still trying to figure out how to make that work. I think asset managers are working hard. I know at VettaFi we just created an index that tries to access private credit through I think closed-end funds, if I remember correctly. But so the point is, maybe this will be the story next year. I think we're still trying to figure out mechanics. And once it's kind of maybe like crypto, advisors are just going to need some time to feel confident in this category to really see that exposure working. So I have a lot of faith in the space. I just think we're not there yet.
I'm not near as optimistic as you. I just don't know if this is something that investors really want in a portfolio. But I try to take a step back and you think about how a lot of our markets, especially on the equity side, you have a lot of companies staying private. And so that is a big chunk of the markets that investors don't have exposure to. And so I get the case here. I have some reservations about how this actually works in an ETF wrapper. I know we've talked about it before, so we'll see. I would just say I'm a little less optimistic than you are. The only other is I think about top stories that in the ETF space that I was going to ask you about, the multi-share class structure. Maybe this is also a story that hasn't quite happened yet, but I don't know if you saw last week there was an assistant director at the SEC's Division of Investment Management that said they are finalizing the process. And they said, quote, they're at the 1 yard line in terms of where this is at. She made it seem like approval was imminent. Any thoughts on that? Is this a story maybe to watch for the remainder of the year? Because it hasn't really happened yet, but it's something that I know coming into the year, we all had our eyes on.
Yeah, it was supposed to happen second quarter. It didn't. Third quarter is about to end and it hasn't yet, but there's still time. Maybe it'll be a fourth quarter story. I'm actually curious about that, Nate. I think, we've been curious to see, okay, once those floodgates open, what happens? But I think none of us really knows what happens. Are these companies from the conversations we have, these mutual fund providers, they're not ready to just turn a switch. Then we have estimates for thousands of ETFs flooding the market. Is that going to happen? How long is that? What's that timeline going to look like? So I think there's way more unknowns than knowns when it comes to this. And I think that's why we've all been anticipating so much. We want to see what happens on the other side of the door. So I think it'll be really interesting 2026. Even if approval comes in 2024, this year, 2025, I don't think we're going to see a lot of action there before the year's over. I think we'll all be talking about this next year as we see the first products come to market through that process and see what that looks like.
All right, so I'm going to put you down top 2 ETF stories in 2025 thus far. I'm going to go with VU with that over 120 billion, and then we'll go crypto ETFs, which is interesting because I think if I were to look back to 2024, those are the top 2 stories of that year as well. But I can't argue with those. I think that's probably right. Give me one under the radar ETF story so far this year. Maybe something that hasn't garnered as much attention as you think it should.
So I think index ETFs don't get a lot of love in terms of conversation these days because we're so obsessed with the rise of active, but there's a lot of interesting things happening in the index space. And if you look at flows into smart beta, remember smart beta? We never talk about smart beta ETFs anymore. Even the term has gone. I don't know what happened to it. We moved on as an industry. But there's a lot of quote unquote smart beta ETFs, index products that are non-market cap weighted ETFs that have gathered a lot of assets. And I pulled out a list for you as examples, IQLT, International Quality, over $4 billion year to date. SPHQ, S&P 500 Quality, same thing. RWL, which is the Invesco revenue weighted ETF, almost $2 billion year to date, $500 million just this quarter. Free cash flow, VFlow, almost $3 billion year to date, continuing every quarter more money. So there's a long list of smart beta ETFs, factor-based ETFs, just interesting weighting schemes that have gathered billions of dollars this year. But we are just, I think, obsessed with active. But I think there's a lot of great strategies delivering a lot of value that we haven't paid a lot of attention to.
You know what? I really like that one. I think that's a good under the radar story. And as you go through that, I think I agree. And I think this is largely being driven by concerns over market concentration risk and valuations, which are on the high side. And I would also say, and I think you were alluding to this makes sense in the context of the rise of ETFs, and that a lot of the same reasons why investors might look to active management would be similar to smart beta, right? They want to do something different than market cap weighted indices. And with smart beta, we talked about this a decade ago. You get the benefit of active management, but you're also removing the human bias and emotion that might plague active managers. That was always a selling point, that there is sort of this active behind the scenes construction. Once you set the rules, but you're doing something different than the indexes, but you remove that emotion and bias. And I thought that made a lot of sense. Plus, you add that a lot of the smart beta ETFs are very competitively priced. So I think that's a good one. I agree. It's funny. I saw that Rob Arnott, the godfather of smart beta, did you see this? He just launched another ETF here. It's a cap-weighted U.S. ETF where they're selecting companies based on some fundamental factors like cash flow and sales. They're still doing some market cap weighting here, but again, they're tweaking that index to try to remove some of this perceived concentration risk out there.
Yeah, it's the market cap based on economic footprint index, and that follows what he launched last year, the deletions index, and there's all sorts of we talked about this earlier this year, Nate, the different ways to slice and dice the S&P 500. I mean, we're still in that exercise, and it's not an active managed exercise; it's an index-based exercise, and I think it's really exciting because there's a lot of great index innovation that is getting lost in the headline of, whoa, look at active. So I think it's a great story.
All right. A few minutes left here as we look ahead to the remainder of the year. What are maybe 2 or 3 ETF stories that you're most interested in tracking, or ones that you think will garner the most attention? And maybe we can set aside the share class story, because I think we both agree that could be a big story in Q4. And I would say let's set aside the crypto ETF story as well. Again, we both think that's going to continue to be a big story. Besides that, anything that you're watching?
So set aside all the good stories. Okay.
Yeah.
I mean, I'm going to continue to watch the AI as a theme space. I think it's a space that has ebbed and flowed, but yet at the same way, persistently going higher. There's a lot of also new indexes coming out in that space, like humanoids, robotics, all sorts of stuff. And I'm just really interested in that space. I recently wrote about, the health tech part of that story, for example. So the beaten down stocks that are also part of this tech, innovation story. So finding the value within this really growthy play, I think it's an area of the market that will continue to be really interesting. If nothing else, because it defies gravity, and we're just fascinated by it. How big can these companies get, and how are they really delivering value? So I'm going to continue to watch that. But I also, on the flip side of that, I'm really interested in this appetite for that diversification. So this week I'm working on an article about gold, because it's like, I think it's had over 30 record highs this year. It's been on a phenomenal run, and it continues to go up. Now people are, there's some emerging conversation about, is it time to sell? But the truth is it continues to be really resilient. Forecasts for gold prices are big for next year. So I'm interested in that, all risk and all protection. That dichotomy this year in the market, I think, has been fascinating. The alternative space has been fascinating. So I'm going to continue to watch these trends to see if anything surprises us in the last quarter.
I like both of those. First, I'll just say shameless plug. On next week's podcast, I will be joined by Dan Ives of Wedbush, along with Colin Rogers of Wedbush Securities. So we're going to go very deep into the AI story. And I also hope Dan's wearing a colorful suit, since I can see him on video. And then gold, I agree. The gold story is interesting because going back to flows, which is where we started the conversation, there's been $28 billion in inflows into the gold ETFs. And it's funny because you might recall that I was the one just pounding the table over the past couple of years saying we would have these monster inflows into gold ETFs, but they never materialized. Now, all of a sudden, investors are plowing money into these ETFs. And I think that actually makes me a little nervous right now, given gold is viewed as a hedge. And you add that to the flows into Bitcoin ETFs as well, right? Not to bring it back to crypto, but I do think it's interesting that investors are plowing money into both gold and Bitcoin ETFs at the same time, because Bitcoin is thought of as quote unquote digital gold. And so if you believe that, that's another $20 billion in spot Bitcoin ETF flows going into this hedge, just something to think about, right? And I'd also say, if you look at performance, people don't necessarily, I think people view gold as kind of stodgy. Maybe it can't be a high flyer. But if you look at gold this year, it's up nearly 40% versus 14% on the S&P 500. Imagine if it's up another 10% in Q4. It gets up to 50%. So I agree. I think that's an interesting story to watch.
Yeah, and we know that performance sells. If when gold is just going sideways or not doing anything, folks who own it for conviction of diversification. But when it performs like it has, then it brings in all sorts of other players to the space, for sure.
Well, Cinthia, fun chat this week. I certainly look forward to the remainder of 2025. We'll see what ETFs have in store for us. But a fun conversation this week, and thank you for joining me.
Yeah, always a pleasure, Nate.
That was Cinthia Murphy, investment strategist at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
At Lazard Asset Management, we look beyond what the world sees today to help our clients achieve their unique financial goals. Our powerful suite of active ETFs reflects decades of experience from our specialized investment teams and a commitment to delivering results. Experience the power of active investing with Lazard. Visit lazardassetmanagement.com to learn more. The Lazard ETFs are distributed by Foresight Fund Services, LLC.
I'm now joined by Daniel Noonan, Executive Vice President and Head of the Wealth Management Consulting Group at Cohen Steers, who entered the ETF space back in February with the launch of 3 actively managed products. And as I noted at the top, Cohen Steers, we are talking about a $90 billion asset manager and one who has very strong expertise, especially in real assets and alternative income. And Dan is now joining me from New York. Dan, it is a pleasure. Welcome to the podcast.
Oh, thanks so much, Nate. Really happy to be here and appreciate you having me on.
All right. So I think the easy place to start is simply around the decision to get involved with ETFs. As I was just mentioning, Cohen Steers manages some $90 billion in assets. That's across mutual funds, closed-end funds, SMAs, et cetera. But the firm did not launch its first ETFs until earlier this year. And so just take us through that decision-making process. Why now?
Sure, Nate. When you look at Cohen and Steers and you look at our history, it's a history of innovation. Marty Cohen and Bob Steers formed the firm in the mid to late 80s with the idea of taking real estate investing in REITs and putting them in a mutual fund format and providing professional active management for investors. And it's proved highly successful. It's a performance alpha driven firm. And as you mentioned, we've been now entrusted with over $90 billion in assets across not just real estate strategies, but real assets and alternative income capabilities across a wide range of vehicles. But when you look at the ETF space and you look at the growth that we've seen in that market, it's clearly an area that clients have been voting with their wallets to shift their business and their clients' assets into the ETF structure. And Cohen and Steers wanted to meet our clients where they wanted to be met from a vehicle standpoint. So, some may say we were a little bit deliberate in our evaluation of the ETF vehicle. But like everything we do here, we wanted to make sure that it was done, with excellence and in our clients' best interest. So there was a lot of work that went in behind the scenes to make sure that if we entered the ETF market, we would deliver the same investment and performance profile that our clients have trusted us, to deliver. But also, and I think something that gets, not mentioned as much, we wanted to make sure that the infrastructure from a trading perspective here at the firm, from a regulatory perspective, from a risk, compliance, distribution, data, all of the things that go into having a successful ETF business that are oftentimes behind the scenes, that we really covered off on those things and had a thoughtful strategy as to, when we entered the ETF industry, we would do so successfully and we would do so in a way that our clients, expect of us. So I think the firm was deliberate. And made some really good decisions strategically, and we're now benefiting from a lot of thought that went in over a multi-year period of evaluating the ETF space.
You mentioned wanting to meet investors where they want to be met, and you alluded to the growth of ETFs and really active ETFs overall, because the Cohen and Steers ETFs are actively managed, as I noted. I'm curious, what do you think has been driving that interest in active ETFs? And I've obviously covered this a lot on the podcast, especially over the past couple of years, but I'd love to hear what you attribute this increase in demand to, because this has been a huge story.
Yeah, absolutely. And I think if you take a step back and look at the ETF industry going back, to the mid 90s, it was originally a purely beta instrument. It was a trading instrument, designed to provide institutional investors intraday access to the U.S. stock market, and it's clearly evolved quite a bit. In the subsequent years, I've been fortunate to have been part of the ETF industry since the early 2000s, and we saw equity beta ETFs, then we saw fixed income ETFs, we saw commodity ETFs, and the wrapper has continued to evolve to allow for that chassis to deliver, different types of return streams and different types of risk deliverance, via the vehicle. And, active ETFs aren't necessarily a new phenomenon, but I think for a long time, it was a question of, why would you want the ETF vehicle for an active strategy? And I think a lot of, early active ETF managers were launching because they saw huge outflows from their active mutual fund business, largely because they weren't able to deliver the performance relative to the benchmark that the passive ETFs were providing. And they thought that if they launched an ETF, it would be the solution to their problem, but they were, simply just delivering the same, maybe mediocre investment performance in an ETF vehicle. There were questions around transparency, and showing your holdings as an active manager on the daily basis. There were semi-transparent structures. So the industry kind of went through this period where it was a question of, are active ETFs going to be a viable solution? And I think the answer has definitively moved to yes, because for a number of reasons. One, active ETF providers, issuers have launched strategies that do outperform their benchmark. And investors oftentimes want access to those strategies in certain asset classes. And we can get into that with respect to Cohen and Steers. And I think from a regulatory perspective, you've seen the ETF rule make it easier for issuers to launch active ETFs. And then finally, I think from a client standpoint, the evolution of the wealth management industry and the growth of the RIA business and the growth of multi-custodial practices and trading systems have just made the ETF vehicle such a preferred tool to run a practice with. And increasingly, clients are telling us, we really appreciate the performance and profile of Cohen and Steers products, but we need it in an ETF format because of the way our business is evolving, the way that our clients, are interfacing with our firm, and therefore the ETF vehicles really become the preferred, tool for advisors that are running large, modern wealth management practices. So for all of those reasons, I think you've seen active ETFs really explode in terms of assets, and clearly we want to be part of that.
So if we have that as the backdrop on the ETF side, I'd love to have you talk a little bit more about Cohen and Steers' particular expertise. And I noted you've long been a leader in actively managed REITs and preferred securities. The firm has also been a longtime investor in natural resource equities. Talk more about the overall investment approach here and why the focus on real assets and alternative income.
Yeah, absolutely, Nate. So Cohen and Steers is a highly specialized manager. We specialize, as you said, in real assets and alternative income. We specialize in asset classes that we believe are inefficient relative to benchmark or beta exposure. And we have a long track record of being able to produce consistent alpha, over those benchmarks, specifically in areas like real estate, natural resource equities, preferred securities. These are areas where we've got significant track records in our mutual fund business, in our institutional business, in our SMA business, where we've provided clients with consistent alpha in performance relative to benchmark. We are very different from kind of the supermarket asset managers that you see out in the marketplace. We do a few things. We do them incredibly well. We have long-standing portfolio managers that have been with the firm for a long time. We are a investment-led firm, and we exist purely based on our ability to deliver performance. So as a result of that, we're highly concentrated in the asset classes that we deliver for clients. We consistently produce alpha in those asset classes, and those are asset classes that we believe are differentiated, they're inefficient, and importantly, provide a really important role in client portfolios in terms of a portfolio construction standpoint.
All right, so let's give people a flavor here and just briefly go through each of the three ETFs. So I'll tee these up. Perhaps you can offer a few quick comments. First, there's the Cohen and Steers Real Estate Active ETF, ticker CSRE. Just give us a quick snapshot on this one.
Yeah, absolutely. So real estate is how the firm was founded. It's our flagship capability, and CSRE is we went to our portfolio managers and said, if you had a clean sheet of paper and you were launching a new real estate equity strategy, how would you design it? How would you keep it consistent with the guidelines and profile that our clients know us for? But how would you tweak on the margin to take a new portfolio and have it deliver for clients? So they've adjusted the guidelines slightly to allow for a bit more international and global exposure. But by and large, it's the same portfolio managers, it's the same process, it's the same performance characteristics that clients have known us for over 30 years in the real estate space.
Okay, so that's real estate. Next, there's the Cohen and Steers Preferred and Income Opportunities Active ETF, ticker symbol CSPF. Again, just briefly take us through this one.
Yeah, very similar strategy. From an alpha and from a performance standpoint, Cohen and Steers was an innovator in preferred securities. We like to say that we actually helped advisors understand preferred securities. They were accustomed to dealing with individual securities, and we really helped educate them on the benefits of diversification, on the differences and nuances between the institutional preferred market versus the retail preferred market. And we're providing mutual fund exposure in the space for a number of years. We have a leading complex in that marketplace. And again, we asked our portfolio management team to take a clean sheet of paper, to look at the dynamics that are changing in the preferred markets and the issuers that they work with, and design a product that would, again, deliver an alpha and performance profiles consistent with what our clients expect, but do so in a way that is from a go forward basis is going to provide a slightly differentiated exposure for our clients. And again, that ETF is outperforming its index, it's outperforming its mutual fund counterpart, and is off to a really fast start for our team here at Cohen Steers.
Okay, and then the third ETF is the Cohen Steers Natural Resources Active ETF, ticker CSNR. This holds the stocks of companies involved in different aspects of natural resources, such as energy and agriculture, correct?
That's correct. This one's a little bit different. This is actually our first 40 Act vehicle that provides exposure to this market on a dedicated basis. This was a sleeve that we run inside of our multi-asset class real asset portfolio that combines natural resource equities, real estate, infrastructure, commodities, and a small portion of fixed income. And we took that active sleeve and launched it as a dedicated strategy with CSNR. And it's off to a fantastic start. As you mentioned, it combines energy securities alongside metals and mining and agriculture in a way that's highly differentiated from the traditional beta indices, in a way that outperforms the traditional beta indices that are used out in the marketplace. And what we're trying to do here, Nate, is give investors the ability to access alpha producing capabilities in these real asset categories, and allow them to build and construct real asset portfolios for their clients that are going to achieve diversification benefits, inflation sensitivity, and return profile on a longer term basis. So this was a newer strategy for the team. The feedback from clients has been exceptionally strong, and we're really excited to be taking that strategy out into the market.
So as you just went through all three of those ETFs, I heard the word alpha in all three, which I would expect because these are actively managed products. So you're pursuing alpha. Can you talk more just about what you perceive as the value of active management, specifically in the areas of real assets and alternative income? Because I know you have seen all of the broader data on active management, right? When you look at categories like large cap US stocks, the after fee performance track record isn't great. And so what does that look like in real assets and alt income?
Yeah, absolutely, Nate. I think if you talk with a lot of advisors and their end clients, a lot of them have thrown in the towel on broad-based active management. I think the net flows that you would see in the industry would corroborate that, and the tremendous growth of passive investing. And for a lot of investors, that's been a good trade. They haven't given up much, or in fact, they probably gained something, relative to a lot of sort of bulge bracket underperforming active managers. So with that sort of as a backdrop, I think what Cohen and Steers does is entirely different. As I mentioned a few times, we're highly specialized, and we specialize in asset classes where that's not the case, where beta doesn't outperform. And if you take Cohen and Steers, off the page for a second, these are just asset classes that the indices don't make as much sense, that the indices are less efficient. And if you look at something like the preferred market, oftentimes leave out huge components of in this case, institutional preferreds that provide a different, unique exposure for clients. So, active management has a place, but you need to earn that place. And I think that Cohen and Steers, through its history, has earned the relevancy and assets of clients that want active exposure to highly specialized, parts of the market where we can consistently deliver performance. If we can't deliver performance, we don't exist. So it's similar in the fixed income market. You see a similar shift happening where active management does work, and the aggregate benchmark is relatively inefficient, and for a lot of reasons, active managers can outperform some of these benchmarks. Active management deserves a space and earns its fee on a net of fee performance basis in those asset classes.
If we were to set the active management component aside here for a moment, I'd love to have you talk more about the overall investment case for real assets and preferred securities or alternative income in a portfolio right now. Like, why should an investor who is, say, a traditional 60-40 stock and bond investor, why should they consider these areas right now?
Yeah, absolutely. I mean, I think if you look at the 60-40 portfolio, it's served investors incredibly well, particularly over the past 10 years or so. And if you look at the 60, if you look at the equity component of a 60-40 portfolio, what you've seen is market cap weighted indices do exceptionally well, right? You've seen one of the best bull markets in history the last 10 plus years. But what you also see is a heavy concentration in the Mag 7, as an example of the S&P 500, where you've got 7 stocks, that are now producing sometimes upwards of 50% of the earnings power of the S&P 500, and a significant component of the performance profile of the S&P 500. So technology has become over a 30% weight. It's doubled in the past several years. So that trade has worked exceptionally well for investors, and it may continue to play out depending on your view of the AI story and the capex expenditures that are happening and kind of the arms race that's happening there. But what we would say is that with that as a backdrop, you need to look at the broader return profile. Are the next 10 years going to look the same as the previous 10 years from a return standpoint? Is inflation going to be a more important component of investors' mindset as they think about portfolio construction? Is diversification going to be rewarded? And I think we're seeing some of that this year with some of the international stocks, as an example, performing quite well relative to the S&P 500. So diversification is something that we think is critical to a portfolio from a portfolio construction standpoint, and particularly when you think about the dynamics of what investors are kind of grappling with right now, with this heavy concentration in the traditional indices, with inflation being a concern for investors, and from a return standpoint, potentially looking at some growth opportunities that things like real assets can provide relative to what's kind of worked in the past 10 years. So that's the equity side. If you look at the 40 on the fixed income side, I think what you'll also see is that government securities are a heavy percentage of a lot of the aggregate and indices that are used on the fixed income side. You've got policy questions as with respect to fiscal priorities with the U.S. government, and what that's going to mean on the long end of the curve. Is the bull market that we saw for 20 plus years in fixed income potentially over? And again, is diversification going to be an important part of how you construct a portfolio? Are things like carry going to be an area that you want to emphasize? Is tax sensitivity in fixed income through things like preferred securities going to be of increasingly importance for investors? So we, broadly speaking, I would say that diversification is going to be critically important for investors on a go-forward basis, and that's where things like alternative income and real assets can play a pivotal role for investors and how they design a portfolio.
When you visit with, say, advisors or other investors, are you finding the conversation around diversification more difficult these days? And the way that I would frame this is that I think most investors clearly understand the concept of diversification and why it works over the long term. But most diversified investors haven't exactly been rewarded over the past 5-10 years. You were alluding to it. If you're in large cap, mega cap, U.S. stocks, you've done really well. And diversification it hasn't served you well. But we have seen that change a little bit this year. You alluded to international equities as being one point of that. I'm just curious, do you feel like some of these other asset classes, and we can point to natural resources or preferred securities if we want to talk on the fixed income side, that they need to show that outperformance or show that value first, and then investors come in? Because clearly you're trying to tell investors, hey, you should always be diversified. Here's why you want to own these in a portfolio to begin with. I'm just curious that sort of give and take there, how you think about that or how you're talking about it.
It's an important question, and I would be disingenuous if I didn't say it was challenging, because it's very hard to shift away from something that's working so well, right? When client portfolios are at all-time highs, and advisors are are benefiting from that, and their clients feel great about it, it's difficult to make a shift. It's difficult to kind of take your foot off the gas of what's working and think about what's going to work in the future. So they're challenging conversations. What we find is that advisors that are really trying to look around the corner and think about what their investors are going to be asking about a few years from now, and how they can prepare for that, and how if they get a new client in, or they get a cash flow into an account, do they just want to keep buying a pretty expensive equity market, or do they want to think about diversifying strategies like real assets that are still going to provide a attractive return profile? If the market continues to go up, real assets will do well. But if you see cracks in some of the large Mag 7 stocks, if you see different things happen from an inflation perspective, you're going to be really happy that you have some of these diversifying asset classes, and real assets in particular, in the portfolio, and your clients are going to significantly benefit from that. So when you think about risk and return, and you think about true diversification, it is hard to make some of these shifts, but we firmly believe that you're going to benefit from that, and that oftentimes that's what advisors are being paid to do, is to take a slightly counter-cyclical position and help diversify their client portfolios.
Dan, just a few minutes left here. If we come back to the ETF lineup overall, I'm really curious how Cohen Steers views the competitive dynamics in the ETF space right now, because obviously you're not early to ETFs, but you do offer a unique value proposition given the expertise in real assets and alt income. So how are you, or how is the firm thinking about the ETF strategy moving forward? How do you compete?
Absolutely. I mean, and the ETF industry has continued to evolve and get more and more competitive every day. I heard a stat the other day. There's more ETFs than individual securities right now. So, the innovation continues to pick up steam in the ETF vehicle perspective. But similar to what a lot of my earlier comments, what we do is quite different at Cohen Steers. We do a few things. We do them exceptionally well, and we deliver for our clients in those areas. So our strategy is fairly simple. We want to deliver the best of what we do in the format that clients want to access Cohen Steers in, and that increasingly is the ETF vehicle. We've got 3 ETFs, as you mentioned, that we launched in February. They're off to a really fast start. We're incredibly happy with both the volume we're seeing in those ETFs and the assets that clients have trusted us with, early days on these funds. So I don't see a scenario in which Cohen Steers is launching dozens of ETFs. What we're going to do is look at our capabilities that we have as a firm. We're going to cover off on the asset classes and strategies and portfolio managers that we have a huge amount of conviction in, and we're going to make sure that we have access to them through the ETF vehicle. I, from a competitive standpoint, when we look at the landscape of ETFs and we look at the passive market in the asset classes that we specialize in, regardless of which way the market moves in those asset classes, we think we have a really, really competitively viable solution for investors that are willing to look at the active side of the ledger. You look at passive ETFs in the real estate space, there's $30+ billion strategies out there that have structurally underperformed Cohen Steers active strategies, for decades. So if we can educate investors around why active makes sense in some of these categories, like real estate, like preferred securities, like natural resource equities, the value proposition that we deliver relative to passive on a net of fee basis, we think we have an incredibly attractive business. And more importantly, we have a better return profile for our clients and for the advisors that work with them. So our strategy is simple, but I think powerful, in that we're just going to launch ETFs in the areas that clients know us for, that they've trusted us to deliver on, and that we know we can provide a solid return stream relative to the passive benchmarks that are out there.
Well, Dan, really enjoyed the conversation this week. Congratulations on the launch of this ETF lineup. I certainly wish you the best of luck moving forward. Thank you for joining me.
Yeah, Nate, thank you very much. Appreciate your time.
That was Daniel Noonan, Executive Vice President and Head of the Wealth Management Consulting Group at Cohen Steers. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Wedbush's Dan Ives and Colin Rogers. We will be discussing artificial intelligence and the Dan Ives Wedbush AI Revolution ETF. And then I'll also be joined by Fidelity's Craig Ebling. He's an ETF strategist there, and we're going to have a full conversation around both options-based ETFs and also tax loss harvesting. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.